Wall Street ended mildly in the green. There are fears of recession, but the Asian markets, they open lower as investors continue to watch the US yield curve, which inverted further overnight. So the Japanese index lower by about 0.5%. There is some, flight to safety as far as the yen is concerned. It has strengthened to levels above 106, trading just shy of that. Markets also await developments coming in on the US-China trade front, as a result of which the Korean market's absolutely flat, but mild red tinge is something that we're seeing out there. The Straits as well as the Taiwanese indices, both of them lower by about 0.25%. And in light of that, the SGX Nifty, that's the one that should come up for you. Remember, yesterday was a muted day of trade, and the SGX Nifty suggests that at the start, it could be a 25-point downtick.
All right, let's also take a look at the U.S. markets now. Wall Street closed high in the overnight session. Now, this even amid all of the volatility induced by the inverted U.S. Treasury yield curve, the U.S.-China trade war, as well as the threat of a no-deal Brexit. So the Dow was around 250 points higher. The S&P 500 climbed 0.7%, while the Nasdaq was also 0.4% higher. We now have CNBC's Julia Borstein to get us a wrap of all of the action on Wall Street.
U.S. stocks getting a boost from the energy sector as oil prices gain steam ahead of the busy holiday weekend. The Dow jumping 258 points, the S&P up 18, and the Nasdaq gaining 29 points. A slight rise in mortgage rates putting a damper on application volumes. According to the Mortgage Bankers Association, total application volume fell 6% last week. Meanwhile, applications to refinance a mortgage have been on a tear this summer as homeowners seek shelter from higher rates. But last week's rate jump spooked homeowners, leading to a drop-off in refinances. Tiffany shares jumping nearly 4% after reporting mixed results for the second quarter. Earnings topped expectations, but revenues came in short as the unrest in Hong Kong disrupted sales. The luxury retailer also grappling with lower demand from foreign tourists visiting the U.S. Apple issuing an apology for listening to some users' conversations with Siri. In a post to its website, Apple said it will no longer store recordings of users' interactions with the voice assistant. The Siri grading program was halted earlier this month after a report in The Guardian said outside contractors were monitoring users' personal conversations with Apple's Siri.
Julia, thanks for taking us through all of that action. But on that note now, let's also hear out some opinion from experts on the recession fears and what they make of the yield curve inversion and central bank actions.
I think the global backdrop is usually bullish. I think there's just a rush for yield. I think people ultimately think that most central banks are going down to zero. Some are already negative. The Fed is perceived in the longer term, I think, as potentially going down to zero as well. That's not an awful lot of stimulus in the package there. So I think people are just looking for duration and looking for yield, and it's a global phenomenon. When you look at September and October and you look at the kind of events that are coming up, the Brexit side, the tariffs that we're likely to have implemented at the end of this month, the beginning of next month, that clarity that we're looking for in terms of US-China is not likely to be there. Hong Kong lurks in the shadows. So I think you've got enough global events that are essentially going to keep this thing rolling in terms of global yields generally suppressed, and I think therefore suppressing US yields.
Cycles end with policy mistakes and inversions of yield curves. Now, just because the yield curve has inverted 4 to 5 basis points doesn't mean that this cycle has to necessarily end. But what it does mean is we need greater clarity on policy. This time is different. The Fed is in an easing cycle, but as long as the uncertainty persists around trade and as long as business sentiment, business investment, new orders all slow, the 10-year is going to go along with that. So what do we need here? We need the Fed to cut interest rates further, and we need clarity from the administration. It doesn't mean we need a trade deal tomorrow, but we can't keep going on with businesses not understanding the rules of the game, because if businesses don't understand the rules of the game, it's very hard to put investment into place, and without investment into place, growth slows.
You can argue that a lot of what we've seen in a movement on the 10-year now prices in a slower growth and inflation scenario, not necessarily one where growth is negative in the US at least. And when you match that with some of the positioning data, yes, the market has moved quite a lot quite quickly. But I think what's interesting is that when you start comparing, sort of matching that up with some of the higher frequency data, look at ISM manufacturing, look at the lead economic indicator. I mean, yes, conditions have weakened, but not that much. I mean, it's still, those indicators still look like the 2011 or 2015 slowdown rather than a recession. And I think that's where we're not willing to sort of go out and say, look, yes, absolutely, recession risk may be a little bit higher than where they were, a couple of quarters back, but that still isn't our central scenario.
I think this is a major red flag about the possibility of recession in the United States. Now, I think that the Fed's effectiveness at fighting recession is greatly reduced, both because we've had 8-10 years of very low rates already, and we don't have a whole lot of runway to cut rates the way we normally would going into a recession, that they would normally cut rates 400-500 basis points. And when you see the 2-year as low as it is to begin with, they just don't have that much space. Now, it doesn't mean we have to have a recession, but for sure the policy moves being announced by the White House got to raise people's fears even more.
All right, and across the Atlantic, the European markets, they ended mixed. The big talking point here is that the Queen has approved British Prime Minister Boris Johnson's plan to suspend Parliament. The highly controversial move will restrict parliamentary time before the Brexit deadline and increase the chances of the UK leaving the European Union with no deal. This led to a sharp fall in the sterling versus the US dollar, which in turn boosted the exporters and hence the FTSE 100 index, as a result of which was higher by almost 25 to 30 odd points. We had mild moves come by on the lower side on both the French as well as the German indices.
Okay, that was the action from Europe. But moving on to the currency space then, the dollar inches up even as recession fears persist. But safe haven Japanese yen also continues to be in demand as renewed trade tensions continue to weigh on investor sentiment.
Akansha. In the world of commodities, crude oil prices fall from highs at close to around $60 per barrel as data from Energy Information Administration showed a steep fall in U.S. crude stockpiles by 10 million barrels. This eased worries about weakening oil demand caused by the trade war between Washington and Beijing. Brent is now hovering around the $60 per barrel mark.